There are many people who want to start investing and grow their money, but at the same time, they are afraid of losing their savings, or they simply don't have the time to follow the stock market and analyze companies every day. Others want to protect their money and make it grow, but they don't know where to start. And that's exactly why one of the most popular investment solutions was created: investment funds. And in today's video, we will learn: what is an investment fund? What are the different types of investment funds? And how can you choose the right fund for your goals? Let's get started. So what exactly is an investment fund? Simply put, an investment fund is a way of pooling money from a large number of people. After that, a professional fund manager is hired to manage the fund. The fund manager takes all of that money and invests it in different assets and investment opportunities. Then, if those investments generate profits, each investor receives their share of the returns based on how much money they invested. This is a simple, beginner-friendly definition of what an investment fund is. Why do people choose investment funds instead of investing on their own? There are three main reasons. First, expertise. Most people are not investment experts, and they may not know how to analyze companies or choose the right investments. That's why investment funds are managed by professional fund managers. Second, diversification. Instead of putting all your money into one investment, a fund spreads the money across multiple assets. This helps reduce risk. And finally, time. Following the market every day takes a lot of time and effort. With an investment fund, the professionals handle the research and investment decisions for you. Types of investment funds. We mainly have three basic types. First, equity funds. These funds mainly invest in stocks, with the goal of achieving the highest possible returns. Second, fixed income funds. These invest in treasury bills, bonds, and bank deposits. The main goal is lower risk for the investor. Third, balanced funds. These are a mix between stocks and fixed income instruments. The goal is moderate to high returns with relatively lower risk. Do all investment funds work the same way? The answer is no. There are two main types you should know: active funds and passive funds. First, active funds. These are funds where a fund manager actively tries to beat the market. They select stocks and constantly adjust the portfolio to achieve higher returns. The advantage is the potential for higher profits, but they usually come with higher fees and don't always outperform the market. Second, passive funds. These funds aim to track the market instead of beating it. They invest in the same components of a specific index, like a stock market index. The benefit is lower fees and more stable performance, but the returns usually match the market, not exceed it. After learning about the different types of investment funds, the question is, which one is the best to invest in? The answer depends on you. If you are looking for high returns with moderate risk, you can invest in equity funds and diversify between active and passive funds. If you don't want any risk and prefer a calm, stable investment, then fixed income funds are the right choice for you. But if you are looking for balance, you can go for balanced funds, which combine both stocks and fixed income instruments. In short, the best fund depends on your goals, risk tolerance, and how you want your money to grow. But if you are looking for higher returns with higher risk, then the solution is investing directly in stocks. Stay tuned for the next video, where we will start explaining fundamental analysis of stocks and how to find the right stock for you. And if you are new to investing, you can watch the previous video, where we explain the basics of investing. Finally, if you enjoyed the video, don't forget to like and subscribe to the channel, so you don't miss any new content about investing and financial life.
Please subscribe and don't forget to hit that bell.